People will look at a crumpled $20 bill and wondered why on earth we all agree it's worth anything. It's basically just a fancy piece of paper, right? Well, today we're diving into the wild story of how we went from trading literal whale teeth to swiping plastic cards and clicking on digital coins. By the end of this, you're going to understand the magic trick that keeps the global economy running and why the money in your bank account isn't actually what you think it is. We're going to cover how money started as simple I owe us, the era of heavy, shiny coins and why it switched to paper, why we switched to paper, and why it's based on trust, the secret of how chiefs and governments keep control, the too much of a good thing problem called inflation, how the US dollar became the world's favorite currency, the difference between inside and outside money, the future of crypto and digital tokens. The early days of keeping tabs. Way back in the day, before anyone had a wallet, people lived in tiny villages. Everyone knew everyone. If you gave your neighbor some grain, you just remembered that they owed you a favor later. It was all about keeping tabs. But as villages turned into towns and then cities, you couldn't remember every single person you'd helped. You also couldn't always trust a stranger to pay you back. People tried using IOU notes, but if you didn't know the guy who wrote the note, it was just a useless scrap of paper. So they started using intermediate stuff. Think whale teeth or fancy shells. These were basically physical IOUs that everyone agreed had value. The crazy thing? The second humans invented money, we also accidentally invented debt. Because the moment you have a token representing a future payment, someone is officially on the hook for it. When money got heavy and shiny. As trade started picking up, those early versions of money started showing their flaws. Imagine trying to carry a giant bag of barley to the next town. It's heavy, it rots, and it's a pain. Or whale teeth? You can't exactly snap one in half to buy a snack. And shells? Well, if you live near a beach, you're suddenly a billionaire, which makes the shells worthless for everyone else. This is where kings stepped in. They realized that if they made coins out of precious metals like gold or silver and stamped their face on them, people would trust the weight and value. It was great for trade between different kingdoms because gold is gold everywhere. But because power makes people greedy, rulers started de-easing the currency. They'd mix in cheap metals or make the coins thinner while pretending they were still worth the full amount. It was the original get-rich-quick scheme for governments. The paper revolution. Eventually, carrying around chests of heavy metal coins became a total drag, especially for long trips. The Chinese were the first to say, "Hey, let's just leave the heavy coins in the palace and carry around paper receipts instead." At first, these were just promises. You could take that paper to a bank and swap it back for actual gold or silver. As trade went global, this paper idea caught on everywhere. People were a bit nervous, though. They worried that governments would just print infinite paper. To fix this, most countries linked their paper money to a gold standard. Basically, for every dollar printed, there was supposed to be a chunk of gold sitting in a vault. But eventually, the world realized that system was too stiff. By the 1970s, we pretty much ditched the gold entirely. Now, the only thing making a $100 bill different from a napkin is the fact that we all trust the government behind it. Who's really in charge? There's a famous story about an island called Yap that is located within the Federated States of Micronesia in the Western Pacific Ocean, where they used giant, heavy stones as money. These stones were so big they didn't even move them. They just traded ownership of the stone. This is basically how banking started. If you own a value somewhere, you can just write a note promising to pay from that value. But here's the catch. Once the local leaders, or chiefs, start accepting these notes for taxes, they lose a bit of control over how much money is actually moving around. In modern times, economists argue about how much money should be in circulation. If there's too much, things get weird. If there's too little, the economy stalls. But it's hard for the government to control it because most money today is actually created by private banks, not the government printing press. The inflation headache. Back in the 16th century, Spain found a mountain of gold and silver in the Americas and brought it all home. They thought they'd be the richest people on Earth forever. But it backfired. Because there was so much new gold moving around, shopkeepers just raised their prices. If everyone has twice as much money, but there are still only 10 loaves of bread, the bread just ends up costing twice as much. This is inflation. The only people who actually won were the people who owed money, because their debts suddenly felt smaller compared to all the new gold. For everyone else, it was a mess. It proves that you can't just print your way to being rich. You actually have to produce more stuff or keep the money moving at a steady pace. The rise of the dollar. In the 1700s, Britain forced the American colonies to use British pounds and banned them from printing their own cash. This forced the colonists to trade only with Britain to get the money they needed for taxes. Benjamin Franklin actually said this was a huge reason for the Revolutionary War. Once the Americans won their freedom, they created the U.S. dollar. Because the U.S. grew into a massive trading powerhouse with a very reliable tax system, the dollar became the gold standard of the world. Even countries like Britain started keeping huge piles of dollars in their reserves. It's a bit ironic, right? The very people who ran away from the pound ended up running the world's most important currency. How banks actually work. By the 1800s, banking was a proper, fancy business. The plan was simple. Pay people a little bit of interest to keep their money in the bank, and then charge other people a higher interest rate to borrow it. But bankers realized something sneaky. Most people don't go to the bank to take out all their cash at the same time. So, they started lending out way more money than they actually had in the vault. This is called fractional reserve banking. It works great until everyone gets scared and runs to the bank at once to grab their cash. This bank run can crash an entire economy. To stop this, governments started insuring your deposits. This actually let banks take even bigger risks, which led to the massive financial mess we saw in 2007 and 2008. The Great Bailout Mystery. After the 2008 crash, governments had to step in to save the day. To understand how, you have to know there are two types of money. There's inside money, which is created by banks when they give out loans, and then there's outside money, which is created by the government. When the banks almost collapsed because of bad loans, the government stepped in and used outside money, public debt, to buy up those bad debts. Basically, the private banks got to keep their wealth because the government took on the debt. It was a massive move that shifted the burden from private companies to the public, all to keep the system from totally vanishing. Why the dollar stays strong. Ever since we stopped using gold to back the dollar in 1973, people have been predicting that the U.S. economy would collapse. They thought that because the US borrows so much and prints so much, the dollar would eventually be worthless. But it's been decades, and the dollar is still super strong. Why? Because the whole world uses it. So many people and countries hold their wealth in dollars that they all need it to stay valuable. It's a giant circle of faith. As long as everyone believes everyone else will keep using the dollar stays powerful. It's essentially a global group hug of financial trust. The future: pixels and crypto. Today, actual cash, the coins and paper, only makes up about 2% of all transactions. Most of our money is just numbers on a screen moving at the speed of light. Now we have things like Bitcoin and other cryptos. They're trying to do what money has always done: be hard to fake, easy to carry, and limited in supply. But here's the reality check. Until you can pay your taxes in Bitcoin, or until a bank gives you a mortgage in it, it's not quite real money yet. It's more like those whale teeth we talked about earlier. The real test will be when governments try to control it. Because at the end of the day, money isn't just about trade. It's about who has the power to control the flow. And that's a power governments aren't going to give up without a fight.